Now, once you've got your market timing system together, the next step is to test it. Before you go into the market, you need to be sure that the results that you can get from your strategy is in line with your expectation. So for this, we have a series of testing that we do before we can put it into production. Now, we are always considering new strategies. So at any point in time, we will always have multiple strategies in different stages of development. So some strategies are being still developed in terms of the entry and exit criteria. Others have been put into testing. Others still are in advanced stages of testing. And then finally, we're going into the live market. So I'll take you through the steps that we undertake before we put a strategy into production. And that's essentially what I would like you to do as well. So once you've put together your entry and exit criteria, as I said, the next step is to test it. What we do first is to utilize a software that takes your entry and exit criteria and applies it to a historical database. So database of all the prices that have actually happened in the live market. So the first step is what we call backtesting. So backtesting, as I said, utilizes historical data. This is done by using software, or you can, in many cases, we've developed our strategies using simple Excel systems. So we download the data and apply that data onto the set of criteria that we have established. What this does is it gives us a series of successful or failed trades. And based on that, we can apply our risk-reward ratio or the amount that we would have made or lost on those series of trades, and then come up with the exact performance that we could have seen. So the result is actually a simulation of what would have happened if you had been applying the strategy over that historical period. Now, obviously, this makes sense if you are using a system that uses technical indicators. So a very technically in-out which is based on price movement. When it comes to fundamental analysis, it becomes a little more tricky. So for strategies based on technical analysis, it's a lot easier. There are many software available, but there are also professional agencies that undertake this. Professional agencies also undertake testing of strategies that use fundamental analysis or analysis that are more visual in nature. So it's a lot more subjective. So for these kind of strategies, you have to necessarily go to an agency, or instead you can move on to paper trading. But in this situation, you have to undertake a little more precaution when you're doing paper trading. So I'll talk about that. But the next step after backtesting is actually going into the live market, but not necessarily taking the trades for yourself. So this is what we call forward testing or paper trading. Although your backtesting data gives you a preliminary proof that there is substance in your strategy, and then if you deploy it in the market, there is the very high likelihood that that you're going to get good returns. Obviously, at that stage itself, at the stage of backtesting, there are a lot of adjustments that we tend to make. That, it's not going according to plan, but if we do tweak this or tweak that, then we will be able to get the kind of results. So after backtesting, what you have is a slightly more refined version of your original strategy. And now you're applying that refined version into the actual live market. But here again, as I said, you're not really putting money into those trades. You're doing what we call paper trading. So in paper trading, you are deploying your strategy in the real market, but only on paper. So you're taking those trades as if you would have actually taken those trades, but you're only jotting it down on a piece of paper. So literally saying, okay, now I would have taken a trade. And at this point, the price is 100 rupees. So at 100 rupees, I've taken a buy order and I've taken X amount of units for it. So you're logging your trades without actually executing it in the market. What this does, or what this stage does, is works out the nuances of actual implementation. You may realize, for example, that this execution of this strategy requires you to be in front of the machine for a lot longer than the time you have available. So you may have to refine your strategy. In that case, in that sense, the strategy is not really executable by you. But besides that, there are many other nuances that come into play. For example, in many situations, there are related, or what we call derivatives of the actual underlying asset. So for example, in the equity market, we trade a lot of options. As you can well imagine, options is our forte. And I have been working on options for the last 15 years. And this has become my expertise. Options are my go-to place, right? But options are a derivative, which means the prices of options are dependent on the underlying asset. So when I've developed a strategy that requires execution or buying of options, then it throws up a fresh challenge. So I have to buy in the derivatives market while looking at the price of the underlying market. So for example, in our weekly income strategy, we look at the performance of the Nifty index and then take our positions in the derivatives market, in the options market. Now there is a linkage, but it's not a one-to-one linkage. So when deploying the strategy, I have to make sure that it is actually executable by the system. How can I look at the Nifty's market and execute in the options market? So these are the nuances that are thrown out when we're actually live trading or virtual trading in the market. At this stage, you will also be presented by a fresh set of challenges which represent your emotional state of being. So when you actually see the kind of profit that you're making or the kind of loss that you're taking, you may not be inclined to actually execute. I've told you that our role as investors, as traders, is to execute our trading system flawlessly. Now, when you are actually trading in the market, you will realize that this is not always that easy, and all those emotions will start coming in. Profit taking, for example, is always a challenge. You see all this money, and you're seeing the market, you're seeing the euphoria in the market, and that euphoria is absorbed by us, and it results in a lot of greed. And we tend to say, no, hold on, maybe a little longer, maybe a little longer, maybe a little longer. And before you know it, the market starts coming down, and the kind of profit you were making, now you're making maybe 3/4 of that or half of that. And you're still saying, no, you know what? I was seeing 10,000 rupees of profit. Now I'm only seeing 5,000 rupees. How can I take that? Before you know it, you're back at break even, maybe even making a loss. And that becomes really challenging in terms of emotional development, emotional control. And while doing paper trading itself, you will be presented with this kind of challenge. And it's important to make a note of it, that this is something that you will be required to look at, to address. I'll address this, of course, in the psychology section, in the mindset section. But at this point, just remember that during the testing itself, you will be presented by this challenge. The important part is go through with it and say, no, I'm going to execute flawlessly. And that's really where the data becomes important. The data that this kind of testing throws up, when you analyze it, you will understand the kind of actual performance you can expect. And then we move on to starting with a limited amount of capital. Now, at this point, the amount is not important. You need a little bit just to get your toe wet. But what is important is to be actually executing in the market, actually seeing those profits line up. Now, the amount of capital, as I said, is not important, but it will be dependent on the kind of strategy that you develop. For example, in our weekly income strategy, the amount of margin required for executing those strategies is 25,000 rupees. Now, that's not a big amount. The amount is not too much, but it is important that you bring in that kind of capital to get started. So depending on what kind of strategy that you are developing, you may be required to bring in the minimum amount of capital. So that is required, but outside of that, there is no restriction on the kind of capital you need to deploy. You can start with just one lot, one unit, doesn't matter. The important part is to seeing your strategy actually work in the market. The kind of time commitment that you will need to get, the kind of analysis that you will need to do, and the kind of monitoring you'll need to manage. So all these is a culmination of all the planning that we have done already. So we've designed and developed our entry and exit criteria, and we have put together the risk management systems, right? We know exactly how much risk we're going to take. We've also looked at the kind of profitability we're looking at. So at this point, you will see all those come together. The importance of this step is to make sure that the market dynamics are taken into account. For example, I had been trading option strategies in the US market, and I thought of deploying that in the Indian market after I came back to the country. But I soon realized that there were certain nuances in the Indian market that made the strategy not so exciting over here. For example, at that point, most of the scripts in the Indian market were still illiquid. That means there weren't many people trading that. Over and above that, the kind of margin that was required for executing these trades was a lot higher than in the US market, which meant that the kind of returns that I was getting were far lower when compared to the kind of capital required. That made it didn't make it too feasible. I had to do a bit of re-engineering to make these strategies work, but I did not understand that before I had actually invested or I had actually taken trades in the live market. So that's something to look out for, those slight nuances that you need to ensure work before you start deploying your strategies in full. And then finally going live with the full capital. Now, once all those wrinkles have been ironed out, once you're sure that you've seen your strategy work in the live market, you're sure that the kind of results that you were anticipating are actually feasible from the strategy, that's the time to go full force. Now's the time to make some serious money. But this can be a very trying experience. But if you've done all your planning, like we've talked about, things should go quite smoothly. Nonetheless, when you look at risk management, I always suggest that we take the previous stage of testing and then move smoothly into the live market. What I mean to say is that we don't say, okay, we're testing just one unit, or we've been trading with just one unit in the limited capital stage of testing, and then suddenly, boom, we go in with 100 units in the next stage of full capital deployment. Although you can afford, or that's what your capital allows you to take, you should still consider phasing in this movement from 1 to 100 units. So this phase, you could do something like, doubling every week or doubling every month. So from 1 unit, you go to 2 to 4 to 8 and just keep scaling in that way. What this does is that it sort of softens the blow that your that your senses, that your psychology, that your emotions take while trading in the market. So you are easing yourself in. And if this is something that you've done for the first time, I strongly recommend this. It allows you to, smooth the process as you come into the market. It's easy taking 1 unit. So 2 units is not an issue. And once you get used to taking 2 units of that kind of exposure, or get yourself exposed to that kind of money, then it becomes easier going to the next stage where you're looking at 4 units. So you don't want to have too much of a jump. You don't want to, impact your heart too much or emotions too much where you land up making silly mistakes. You want to ease yourself into that. So that's a strong suggestion. But you may not be inclined to take it just because, you feel that you're ready to go into the market. If that's the case, go ahead. Your experience does account for something. But if not, if this is something that you're inclined to do, I strongly recommend it. It is something that we constantly do, even in the hedge fund, even in trading our own capital. And definitely when we are advising our clients, people like you who have been taking our strategy, our income system, and deploying it in the live market. If you want to know more about that, of course, I've said this before, but write into us at info@theincomeoption.com and just say that you're interested in the weekly income system or the options trading income system, and we'll get back to you with all those details. So a shameless plug for that over here, but it is a system that we've been working on for a very long time. We've developed it over almost a decade, more than a decade, and it is something that we are so confident about that we feel that it's the next step as far as getting financial freedom is concerned. So again, if that's something you'd like, please write into us and we'll get back to you. So there you have it. You've gone through the system. You have created your strategy, you've tested your strategy, back tested it, then you've got your feet wet with limited amount of capital, and then you've gone full blown and deployed all your capital in the system. Throughout this stage, it's very important to monitor each and every aspect of your trade. So we've shared with you a template for monitoring your trades. Now it's very important that you have that data to look at what kind of performance you've been doing, right? And for that, it is very important that you record each and every trade. Your job, as I said before, is to execute your trades flawlessly. So without letting emotions come in, without cutting any corners. So this is the part where you continue with that discipline and make sure that after every trade, regardless of whether it's been a successful trade or a failed trade or a loss-making trade, you need to record it. So we have the template developed for you. For each and every trade, you will record the date and time that you took that trade, or the date and time that you exited the trade, and the kind of quantity that you took, the price at which you entered, and the price, of course, at which you exited. Now, these parameters are going to give you the all-important data to understand what your strategy is looking like. The risk-reward ratios will come out from that. The kind of expected success ratios are going to come out from that. And using our template, you'll be able to also understand the kind of profitability that we always talk about. And as we know, whatever gets measured gets managed. So once you have that data, it becomes very easy for you. You think it's easy implementing the strategies that you've developed? It's not. It takes a lot of development. And I'll get more into that in the section on psychology of investing. But at this point, remember that you need to record each and every investment, each and every trade that you take. So use the template. You will record the script name, the volume, the entry price, the exit price, everything. With these details, as I said, you will be able to calculate each and every aspect of your trading system. So things like risk-reward ratio, your profitability, your success ratio, even the amount of brokerage will be calculated based on this. Deciding on a strategy is a core part of the investment planning process. But as I've said before, it's not the only part. Now that you've developed the strategy, you've also tested the strategy, we're ready to go into the next phase, which really separates the wheat from the chaff, the professionals from the amateur. It is this mindset of the professional investors that I'm really excited for you. I hope you'll find that at this stage, we've taken a very professional view on the steps that are required to develop a trading system. And I'll hope you'll appreciate that it's far from what you've been trained to do in the amateur setting. Tomorrow we will look at risk management and understand how to manage your risk so that irrespective of what your strategy is, you can land up making money. I'll see you there.